Thanks very much, Jack, and hello everybody. Thanks so much for joining us today for this webinar, where we'll be unpicking one of those subjects that I think can be quite taboo for payments in the money industry at times, and that is wind down planning. In this webinar, we will be looking at the legal aspects of this, taking into account the perspective of the UK and EU's regulatory approaches, and we will also be looking at how to actually implement a wind down plan effectively. At a time when scrutiny is firmly on corporate governance and consumer protection in a variety of jurisdictions, getting your wind down plan right is vital for firms to ensure they stay on the right track and on the right side of their regulator. To start with, I'd like to explain what we do at FCA Regulatory Intelligence. So FCA is a regulatory technology or RegTech company and a trusted source of independent, authoritative and actionable regulatory intelligence for compliance, regulatory strategy and development professionals in highly regulated industries undergoing rapid and radical change. We deliver comprehensive, time-sensitive and actionable intelligence on payments and gambling compliance, covering more than 180 jurisdictions across the globe and organised by product or service type. And to tell you who I am Jimmy Franklin and I work as a senior journalist at FCA Payments Compliance. My role includes looking at some of those huge regulatory developments that are taking shape at the moment in the payments and crypto space. And in recent years, beyond what we're covering today, I have delved into topics such as DORA, the Open Finance Framework, JROC in the UK, the Digital Euro and Digital Pound, AML laws and consumer protection rules. So now I'd like to turn to our esteemed speakers. We've got some really good people coming up today. Martin, let's start with you.
Hi, I'm Martin Dowdall. I'm a Senior Managing Associate at Sidley. I'm a payments and fintech lawyer and advise on everything payments, including wind down plans.
Fantastic. And Robert?
Good afternoon, everyone. I'm Rob Spence. I'm a Director at Interpath Advisory. Interpath Advisory was formed 3 years ago when the UK restructuring team of KPMG got acquired and spun out, and we're now a broader deal advisory business. My focus is in the restructuring and insolvency side in the London team.
Brilliant. Thanks very much, guys. So before we get started on the questions for Martin and Robert, I wanted to reiterate what Jack said and ask everyone to please send through any thoughts you have for us during the webinar. I think that will really help make it more interactive and engaging, and I'll make sure at the end to go through as many Q&As from the audience as we can. For now, though, I'd like to start with a quick explainer of what wind down planning actually is. Perhaps, Martin, we can start with you for that.
Sure. So a wind down plan is a plan to wind down your business, whether that's in a solvent scenario or an insolvent scenario. So the FCA says that plan has to address certain things, and the main things are liquidity. Where is the funding coming from to fund the wind down costs themselves, paying for ongoing operational costs, and really importantly, where's the liquidity coming from to return customer funds, because that's what the FCA really cares about. It also has to address operational risks in a resolution. So have you got the operational resources to wind down the business and also to keep the show on the road until it is wound down? So that will include employees, your service providers, including outsourced service providers, including other group entities that provide you services on an outsourced basis, and also the resolution risk itself. How's that being funded? What are the procedures? How's that going to work? What are the triggers for that process? And what information, what are you doing to keep track of those triggers, whether they're financial, operational, or other triggers? All of that needs to be part of your wind down plan. And that plan should cover a wind down on a solo basis, so just the regulated entity itself, but it should also think about what happens if the group as a whole is winding down. How is that going to affect the regulated firm? And again, particularly important in that context is understanding dependencies on other group entities, so outsourcing technological services that are sourced at a group level, shared resources, which could include employees.
Fantastic, brilliant. And Robert, I don't know if there's anything that you can add to that. Obviously, your role is slightly different when it comes to wind down planning to Martin's.
Yeah, I think as Martin kind of talks about, wind down plans is quite a broad document. There's a lot of considerations and requirements within it. I think in regards to the context of why wind down plans are in place, the FCA have advised that firms will it's not their job to stop firms failing, but they do want to ensure that where firms are failing, that they can perform an orderly wind down, which minimises customer harms. And one of the key areas they think they can help address that is by ensuring firms have got wind down plans in place that develop how that can happen and make sure that the wind down triggers have been identified and are being monitored and there's appropriate governance around that. And I think, wind down plans have been around for some time. Banks and larger financial institutions have had this obligation for many years. And certainly in recent years, there's been a greater focus by regulators in regards to the wind down plans of those businesses. They've been having to get into much more detail. There's a lot more scrutiny of those documents and a lot more guidance coming out of that from the PRA, the Bank of England and the FCA. And I think we're just seeing here, as there have been some failures in the e-money and payment sector, the FCA much greater scrutiny across the controls in these businesses, and therefore both the recent requirements to ensure wind down plans are in place, but equally notifications and DCO letters flagging the fact that they are reviewing and requiring these, and expect more involvement and effort by firms in ensuring that they are in place and appropriate.
Yeah, it might be helpful to talk very quickly about what a wind down plan is not as well. So we talked about what it should cover and what should be in there, but I think firms often struggle a little bit with this, and they present a document that's quite defensive, and it almost feels like a sales pitch. So it says, don't worry about this, the FCA, we're a great business, we're fine, we've got enough funding. That's not the point of the wind down plan. It's very tempting, and it's understandable why firms can get into that defensive mindset, but it is supposed to be a realistic document about, look, what could in principle go wrong? What risks are we as a specific business exposed to? Funding, customer risk, regulatory risk, geographic risk if you operate in certain, markets. It's not a document that says we think we are going to fail and this is what we're going to do about it. It's, look, if the worst were to happen, this is how we would detect that and get as much early warning as possible and respond to it. So I think it's important to bear in mind that this is not a defensive, PR exercise. It's just supposed to evidence that you have thought about that.
Yeah, that's an interesting take, and certainly I can imagine smaller firms who are trying to promote themselves a bit more might kind of take that approach at times accidentally. I wonder as well if there's any kind of pointers you have for what makes an effective wind down plan. And I thought it was interesting, Robert, that you were mentioning, traditional or more incumbent financial institutions like banks may be a bit more used to this. Certainly, we're going to have a lot of e-money and payments professionals tuning in today, looking for ways to optimize their wind down plans. So yeah, I wonder if either of you would be able to elaborate slightly on what you think would make a wind down plan effective.
Shall I go first with that, Martin, and you can add yours
sure.
after? I've kind of thought, two key areas from my side in regards to what makes it effective. I think the first one, every business is different, whether that's the services it provides, the customers, the staff, the suppliers, its IT systems and how they operate and the likes. And therefore, each wind down plan has to be specific for the business that's being considered. And to consider that, you need to understand the legal position, the regulatory position, as well as the practical operational position. And therefore, it's important that it's not done by one person in a room, and it brings together all of the various relevant teams across the business. Putting that into an example, one of the first things that often happens when you go into a wind down is changing the customer services that you're providing, switching those off and reducing them. But in order to do that, you need to consider the legal position. What do your customer T's and C's allow you to do? You need to understand the regulatory position. What does the regulations allow you to do, and time frame to do that? You need to understand the IT platform. How does it operate if you're making these changes? How is that reflected into the IT systems in regards to what the customers access? And then how do you message it to customers? So making sure you get the targeted outcome and customer behaviours are in line with what you're targeting them to do. How do you communicate it? but equally there's communications going out. So how does that impact employees, suppliers, because you want to take them along the journey and don't want them taking adverse actions. And therefore, when considering what could be a fairly simple statement of, remove customer products and services, you need a broad team of input to assess, well, what are all the impacts? How do you do that, and what are all the impacts across that? I think a second key area is, coming back to Martin's comment of what is the purpose and what is management's view on the requirements of it. I think it's really, it shouldn't be seen as a tick box exercise, and there is real value in doing it up front. I think when done, one of the key things that is meant to happen is identifying the risks and issues that may prevent the wind down from being achievable as planned. And whilst you're still, carrying on, and you've got the time in your kind of business as usual activities, then you've got time to take actions to address those issues, try and put in mitigation controls to make sure that should a wind down plan ever be needed, you do have an ability to complete it and do it in a controlled, proper manner without incurring lots of unnecessary costs. So kind of taking on from that prior example, you might do your review and assess that customers may have different terms and conditions depending on what year they signed up. And you might go through an exercise which may take a period of time, but you can kind of build it into your standard processes to bring in all your customers so that they've got aligned T's and C's. So once you go into a wind down plan, it's a much simpler process. You're just referring to one clause, one rule, when you don't have 20 different kind of customer journeys depending on which T's and C's those customers are based on.
Yeah, I agree with all that. Yeah, I think the two words I keep in mind are realistic and actionable. So we talked a bit about being realistic. Look, what are the triggers that would affect your business and maybe put it into trouble? That could be financing, it could be the way the market develops, it could be technological. How are you going to monitor those triggers? Where is the information coming from? What are you going to do about it? When are you going to start reacting? Being realistic about how long this is going to take. It often takes longer than expected to wind up a business, whether insolvent or solvent. The costs as well, you'll have professional fees to insolvency practitioners, lawyers. What are realistic about your cash at hand as well? What's the impact of this on your financing arrangements, for example? Is that triggering any covenants that are going to make finding finance, more difficult? Actionable. Can somebody pick this plan up and do something about it? Can they implement that plan in practice? Does it tell them, who the key suppliers are, where the customer funds are, how to figure out how many funds are owed to how many customers and where? Again, the agreements, as Robert rightly says, what are the triggers for that? Professional staffing as well. People might be jumping ship if things are really bad. How are you going to, deal with that? What about suppliers? Are they going to pull the plug? Again, are the triggers in their agreements upon an insolvency event, for example, which means they can suspend or terminate their services? If that happens, what are you going to do about it? Can you bring that in-house? Do you have alternative suppliers? So they're the two principles, I think: being realistic and making sure this is actionable to a senior member of staff or an insolvency practitioner, potentially, if the worst comes to the worst. And also keeping in mind, what does the regulator really care about? It doesn't care necessarily about your equity for your shareholders. It might not necessarily care about your professional creditors, your service providers, but it really, really cares about your customers. How are they going to get their money back? When are they going to get their money back? But also, what about the continuity of their services? Some of your customers may well really depend on your services if they're e-commerce merchants, and that's how they get paid and make a living. So it's not just thinking about what's the financial impact in terms of how much of their money do they get back. It's also, how are we going to make sure we give customers adequate notice and help them transition to another service provider? Because what you don't want is a cliff edge where everything just stops working and your customers are, left out in the cold.
Yeah, absolutely. And I wonder as well, Martin, if you could elaborate on how often firms should be updating this document, because often I've seen it being described almost as like a kind of living, breathing document. And I'm sure that some firms could be guilty of maybe just kind of writing it up and then trying not to think about it and leaving it somewhere. So yeah, it'd be great to get your views on that.
Yeah, well, don't do that. Don't leave it on a dusty shelf and never look at it again, I guess is the easy answer. But no, you're right. It is supposed to be a living, breathing document. What does that mean? Well, at the very least, you have to review this annually and update it if something has changed. But you should also be updating this plan if something has materially changed in the business that would affect the way you do a wind up or what a wind up looks like. So, a good example is, let's say you're a payments firm that participates in payment systems indirectly, and you start instead to participate directly, become a direct member of a scheme or FBS. That makes things a bit different for you. That will affect the way you wind up that business. There'll be additional pressures there. It could be a new product or a new service that comes with different risks. So let's say you upgrade your license and become an EMI, and you're now storing customer funds. That's a different risk. You'll potentially be holding customer funds for longer, and you'll have to think about liquidity in a slightly different way. It could be technological change. It could be a change to regulatory and licensing requirements. It could be all sorts of things. But if it's going to affect the way you do business and what a resolution or an insolvency would look like, then you need to be taking account of that in your plan. And the FCA will expect that as well. I think if the FCA sees a document that's badly out of date, it will have lots of questions, not just about that plan, but also about the strength of your policies, procedures, systems, and controls generally.
Yeah, absolutely. And regarding the FCA's approach to wind down planning, I think I did report on some of the guidance they released earlier this year, and it'd be interesting to know how their approach to this has evolved, particularly for e-money and payments firms, and maybe also a bit about whether it aligns with different regulations that are out there, such as the consumer duty or the operational resilience rules that are coming in next year. Martin, I don't know if that's something that you'd be able to comment on.
Yeah, I think all of those are connected. And anytime you have retail or consumer customers, I think the FCA is going to be particularly interested in that and making sure that any risks and harms to those sorts of customers are mitigated. So yeah, I think you do need to consider the consumer duty in this context. Are your plans to suspend or terminate services in the event of an insolvency fair to consumers if you take an account of how they depend on your services? In terms of how the FCA thinks about it, well, they think about it a lot. It's very important for them. It's a key priority of the FCA, and we know that because they told us in 2023 in their priorities for payments firms. So it's very high up the agenda. Jimmy and I think Robert mentioned Wirecard. I think we still live a little bit in the shadow of Wirecard, and a lot of this is, partly a response to the issues that arose with Wirecard. And the FCA has also given us quite helpful feedback on what it thinks about these plans when they're good ones and when they're not so good ones. It's given feedback on what it expects from firms, and it's given feedback on what it's seen from firms that it's not, particularly happy with. So the FCA has been, pretty helpful, I think, in giving clear guidance on this. And it does care, not just when you're getting authorised, because it's a requirement now, but also on an ongoing basis. So it's taken very seriously.
Interesting, nice. And in terms of the EU's approach to wind down planning, obviously at the moment the PSD3 and the Payment Services Regulation are being negotiated by the EU's institutions, or at least they will be once everyone's back in place after the elections. It'd be interesting to know whether there's any changes that we can expect to expectations for wind down planning in the EU.
Well, I think it's probably a little bit too early to tell, but what we do know is that PSD3 is going to introduce a requirement for you to have one of these if you're in the payment sector. So, I'll give the description of what that should include, and I expect it will sound very familiar to those who've been listening to our discussion of the UK regime. So the plan should describe what would happen in the event of the firm's failure, support the orderly wind-up of its activities, address the continuity or recovery of critical activities performed by the payments institution, outsource service providers, and also the impact on your agents and distributors if that's relevant to your business. So far, so familiar, right? I think it remains to be seen how individual member states will think about this, and requirements and expectations may differ a little bit, but I think it will be very similar to the FCA's approach. Now, if you're authorised in the UK and the EU, look, the devil is always in the detail, so it'll be very important to understand, look, are there important points of differences, nuances, are there competing obligations, and how do we come up with a solution that will work in both markets, taking account of perhaps unique features in those markets. Maybe you do things a little bit differently, maybe your services and products are a little bit different. But I think the principles will be very similar.
Yeah, because that was going to be my follow-up question. Like, do you think that you will need to have a separate document for the UK and the EU if you're operating in both jurisdictions? Yeah. So yeah, it'd be interesting to also know where do you see?
Sorry, I think I lost my connection for a second. Yeah.
All right, no worries. Yeah, so Martin, one thing I was going to ask is if in the UK and EU, let's say if you're operating in both jurisdictions, would you need to have separate wind down documents for both jurisdictions?
I would expect so. Yeah, I think the FCA will want to see a plan that specifically addresses the FCA's expectations, and I would expect EU regulators to take a similar view. Look, they may end up being very similar documents, but I think it is important just optically to make sure they are tailored to the relevant regulators' expectations. Because I think if you were to send something to the FCA that talked about, you know, the SEPA scheme or, you know, European specific obligations and risk, it would not be a good look. And if it's plastered with references to CSSF requirements, the FCA may take a dim view of that and wonder, have you really considered the UK regulations specifically and our expectations and the UK market? So yeah, I think they probably, in most cases, if not all, would have to be separate plans.
Interesting. Nice. And Robert, obviously you're helping firms implement wind down plans in the market. It would be interesting to know from you, where do you see the most common mistakes in these documents?
Yeah, kind of Martin mentioned earlier about ensuring that they're realistic, and kind of got a few examples of areas that we kind of looked at. I think often they are overly optimistic in regards to the time frame and the amount of work required to wind down businesses. So, you know, how quickly will customer behaviours mean that customers come forward and have their kind of funds returned? What's the time it takes to decommission the IT environment? How much effort is there in continuing to comply with statutory requests to provide customer records beyond the cessation of operations? There's quite an extensive kind of range of tasks that a business has to consider, and often the wind down plans underestimate this work. So one recent example we looked at, they had a 6-month process to complete the work, and after the first few questions that we talked through, that had grown to an 18-month process, which for that business was a much more realistic time frame. There's always, I think, an element with wind down plans that for the vast majority, you'll develop your wind down plan is based on a theoretical scenario, and yes, it might get updated on an annual basis, but largely it'll sit on the shelf and never really be tested and challenged, except for a bit of scrutiny and review by the FCA. But I think there are some like key areas within the wind down plan that the FCA can verify and can challenge on. So, you know, kind of talking earlier about customer terms and conditions, you know, we reviewed one. It said that they're going to cease providing certain services to customers after 30 days following the decision to wind down. However, the T's and C's and the regulatory requirements flagged you need 60 days notice. So quickly, kind of one of the initial assumptions in the wind down plan was found to be inaccurate and false. And certainly if the FCA saw that, I think they'd take a much more sceptical view as they read through the rest of the document and whether, you know, full consideration had been done in regards to the wind down plan. I think thirdly, there's a lot of third-party behaviours impacted by a decision to wind down. So debtors will try and take advantage and will stop making payments, much harder to recover, and you have to consider alternative strategies for recovering balances which otherwise would have just been paid on their normal terms. Suppliers will often remove credit terms. Martin flagged risks of contracts being terminated early, but equally, even if they continue to provide services, they'll often remove credit terms and require payment upfront, and may, for contracts going forward, it might be shorter term contracts, and therefore they'll inflate prices to reflect that. And then, how do you retain staff? Retention bonuses are often kind of an essential tool needed in wind down. So have you included those, considered those, and make sure you've made a kind of estimated amount for what those will look like in your forecast. And I think finally, when you're doing your cost analysis, your cost estimate, you've got to show it's complete. The FCA will always expect that there's increased professional fees, or some element of professional fees involved as part of winding down. It might be legal, might be regulatory, it might be tax, it might be financial, it might be insolvency side, but there will be different elements of professional advice needed, and therefore making sure you've got that line within your wind down cost forecast for those professional fees is a good way of just showing that yes, you've considered all those additional costs and completed a full picture.
Yeah, and that sort of detail is absolutely key, isn't it? And look, and that is, completely accords with what the FCA has said. What Robert was just saying, it gave feedback on these plans, and it said some of them are overly optimistic about the time it would take to do a wind down, insufficient detail about the steps for doing a wind down. So a lot of you listening will live and breathe payments, and if you work in the Treasury department for a payments firm, lots of things that are completely obvious to you might not be obvious, frankly, to the regulator reviewing it occasionally, but certainly to somebody who has to come in to help, resolve a business, an insolvency practitioner. So, we will return customer funds, full stop, isn't going to cut it, right? How's that going to work? We are going to, reconcile using this system. We're going to talk to our banking partners. We're going to ensure, we're able to settle to customers. This is how we'll identify balances. This is how we'll deal with in-flight payments. This is how we'll deal with, continuing services and the safeguarding obligations that go along those. This is who we'll talk to. This is who'll be responsible for these steps. The triggers again, how are you going to keep an eye on those triggers? When are you going to react to those triggers? When do those triggers get to a point when it makes sense to get insolvency advice or start a formal insolvency procedure? How does that work? Do you have a list of people that you would go to? Do you have terms of business and engagement letters with professional advisors that you'll need to help? Because that can take time as well. And again, as Robert says, the costs, have you actually really thought about the costs, break costs, financing costs, contractual, penalties, as well as the professional costs? It really does have to be, a very detailed plan that somebody who doesn't know your business inside out can pick up and action.
Yeah, absolutely. And I wonder, in terms of how the FCA checks in on this, is there like a rhythm to it? Is there like a standard for when you're supposed to submit your wind down plans to the FCA for them to check in on, or is it all a bit more spontaneous?
I think it very much depends on what the regulator is, focused on, what's happening in the market, what they know about your business. I think it really does depend. Sorry to give a lawyer's answer on that one.
No, that's right. Thought I'd ask. And then it'd be great to know a bit about what the implications are for not complying with this. I don't know which one of you wants to take that.
So I can certainly have a few observations about when companies have been in distress, and one of the, they've done reporting to the FCA, and the FCA have requested the wind down plan, and it's subject to scrutiny at that point. And I think when those plans have not been deemed to be to kind of an appropriate standard, but following that review and they've needed work, it has caused a number of different issues for the firms. Now, I think in the worst case, you know, the time it takes to develop the wind down plan in that situation, at the end of it, it was identified that the company had already kind of gone past the point of being able to complete a solvent wind down, didn't have time to take any kind of recovery actions to try and get a rescue or try and get a deal away to rescue the business, and instead had no options but to enter an insolvency process. Equally, there's often a bit of a window of uncertainty, and whilst that wind down plan is still being prepared, the FCA certainly have concerns and may well put restrictions on the business whilst the wind down plan is being developed, when they're in a position of uncertainty in regards to whether the company can wind down or not. And those restrictions can create additional work for the firm to deal with, but equally can limit the firm's ability to generate income, which again causes greater financial pressure and can increase the risk of the firm needing to go into an insolvency process. Also, that kind of grey zone causes some very difficult situations for management. They're having to make decisions with incomplete information, and that can put them at risk, so it can leave them open and in a very tricky situation. I think the other point, flagged earlier, part of the purpose of having a wind down plan up front is that it gives you time to take actions to, once you've identified issues, to take mitigation actions and to make it a much more robust plan. Now, if you've not had time to do that because you haven't developed the wind down properly previously, then you're left being forced to do a wind down in kind of imperfect situation with various obstacles that you're going to have to come, and therefore it's a much more lengthy and expensive wind down process. And therefore, if there are any funds left for the shareholders at the end, they're significantly reduced because of those inefficiencies. So up front, there is significant benefit in ensuring that the wind down plans have been done correctly first. Well, Martin, you might have a few insights.
Yeah, I completely agree with that. The first point is exactly that. It will make your life a lot harder if you do have to do a wind down. Much harder and much more expensive than it could be if you had a real, clear, actionable plan. The FCA won't be happy for a start if the plan's not up to scratch. It might view that as a failure of your systems and controls, and then all usual penalties potentially apply, fines, public censure. But also, a sloppily worded and sloppily presented plan could make the FCA start to question other things. So the plan isn't clear as to how you will identify outstanding customer funds and your plan to get them back. The FCA might be minded to ask questions about your safeguarding procedures and your procedures for reconciling customer funds. If it isn't clear where your dependencies are in terms of outsourcing, and the FCA might start to think about your outsourcing obligations. Do you have a register? You should be able to identify who you outsource services to. So you're starting to risk setting hairs running in various other areas of your business as well. And those may not actually be issues in practice, but a poor wind down plan can give the FCA the wrong impression and lead it to start asking, difficult questions.
Absolutely, and I'm glad that we've got some questions coming in as well. But just before we turn to that, I thought it'd be good to ask, maybe this is a bit provocative, but is it a priority for firms that you're working with at the moment? And do you think that firms are taking it more seriously than perhaps they did a few years ago?
Yeah, I think that. Look, I think firms generally take their regulatory responsibilities very, very seriously. I think they're all trying to do the right thing. It's difficult for firms in this sector at the moment because there is just so much in terms of regulatory reform. We talk about the consumer duty. There's all sorts of things going on in the sector that there's a lot to think about. And I think some of this is psychological, right? Look, businesses want to focus on success and growth and developing new products and services. It requires a bit of a mindset shift, I think, to think about this sort of thing in the right way. Thinking about, look, what could go wrong and what would we do about it? But I think it's important not to see that as an admission of failure or a weakness. I think, on the contrary, it can be a real demonstration of organizational strength. A really good plan gives your regulator comfort that you're doing things in the right way. You have strong systems and controls, but I also think it can give a firm the confidence to grow and scale, because if you thought about the things that could go wrong and the potential threats to a firm, that can help inform your strategy. How do we go about growth? Do we need to be doing things slightly differently? It might inform your decisions around new products and services. So I think you can look at it from the other perspective and think, how could really thinking about the risks and what could go wrong and what we do about it inform the way we make the business even better and even bigger and even more successful?
Absolutely. And I don't know if there's anything you wanted to add to that, Robert.
No, I certainly agree with Martin's comments there. We always come up with the challenge of the business is prioritising plan A, plan B, the growth of the business, and ensuring that the wind down plan is never needed by getting the firm profitable and growing it. So it's always a challenge, noting you do need a lot of input across the business in regards to developing that wind down plan as a contingency document to be managed. But there is real value and benefit to the businesses in doing that, getting the confidence of the regulator, and suppliers or customers should take comfort in the fact that they understand that the businesses have gone through the process and have robust plans in place and have considered how what wind down could be considered if needed. And it's really that thing, you never know when they're going to be needed. You always hope it won't be needed, but often they can be in a very short notice. And it's just over a year ago this time, we got engaged on the Friday to support Silicon Valley Bank, the UK entity, and on the Friday we got engaged. On Monday was lined up to be the insolvency appointment. Now management all weekend were working on that plan A sale process, and therefore ourselves looking at the plan B, the insolvency process, we heavily relied on the wind down document to inform our strategy for that day one. So management were distracted, and therefore that document was critical for the work, albeit would have been quite a challenging day one, minimising the impact of the kind of short preparation period for that day one activity.
Yeah, and that's a great example, isn't it? Because your management time is always at a premium, and when things are stressful and potentially going wrong, it's really going to be at a premium. So having this plan helps free up some of that management time. And the case you mentioned is really important as well, because again, I don't think firms should be defensive about these plans. It's not an admission that you're teetering on the edge. That's not the point of these plans. But things can go wrong, and that might be nothing to do with you. If an acquirer that you rely on to give you access to card schemes falls over, that's not your fault, but that's something that could happen. So that should be in the wind down plan. And again, that can help inform your strategy and help make the business stronger. Well, okay, are we overly exposed to a certain partner? Does that mean we should think about being a participant of the card scheme ourselves, or should we look into alternative payment methods as well? Should we have a whole panel of acquirers that we can send things to? Things like that, I think, can help you grow the business, make it stronger, and also talk to senior business people in a way that's a bit more palatable for them, and less scary, frankly, as well. And I think that goes for your regulatory obligations generally as well. Lawyers are often focused on the downside, what could go wrong, but that can be the basis for opportunities to talk about how you can do things better. So let's take AML, KYC, for example. I think people see that as, oh, we've got to do this, and we're scared if we get it wrong, the regulator will come and hit us with its big stick. But if you have confidence that your AML procedures are robust, then that gives you the confidence to scale faster. Look, we know we can get customers on board because we know we're doing the right thing, and therefore this is something that can help us grow and be successful. And I think the same mentality for a wind down plan can be a really helpful way to think about it and to get buy-in from all the people that you will need to help support that plan, from the business and treasury and IT and all sorts of departments.
Yeah, absolutely. And turning on to the questions from the audience now, one question we've got is, what is a reasonable time frame for a complete wind down? I don't know if either of you wants to take that one.
This is probably one for Robert, but I guess longer than you might expect is the short answer. But Robert, you probably have a better answer than that.
Well, the FCA guidance is the wind down plan is once the permissions are being removed, so all your regulated activity has finished. For e-money institutions, there's an obligation. Well, customers can redeem their funds for a period of 6 years. So unless you can find a kind of an ability to transfer that obligation to other parties, then kind of in theory for a lot of EMIs, if you've got funds that might be unclaimed and customers have a 6-year period to redeem them, then in theory your wind down plan should continue throughout that 6-year period. Now that's an extended period for a lot of businesses, and there'll be multiple phases through that wind down process, and there are potential routes to bring that time frame forward, but yes, they can be as long as 6 years. They can be much quicker depending on the business structure.
Yeah, and it really will depend, won't it, on what you do. I know it sounds obvious, but if you're a money remitter, then it might not take as long as it would if you're an acquirer, where you have to think about refunds and managing chargeback risks, and maybe you only settle to your customers once a month, so that will sort of elongate the process potentially. Whereas a money remitter, it might not have lots of outstanding liabilities because the money comes in and it's gone pretty quickly in that context.
Brilliant. And another question we've got is, who should be responsible for leading on wind down plans, and should this sit with the compliance team?
Well, I think lots of people should be involved. It probably makes sense that compliance sort of own it and run the show, as it were. But obviously you need senior managers to approve it as well. So it should really be up to the board level, I think, approving this plan and reviewing it. The day-to-day, maybe that does sit with compliance and legal, but you'll need input from IT. Is that workable? Is that achievable? Are there operational dependencies that maybe the legal and compliance team are best placed to think about? But yeah, you will need your senior managers, your board, to be signing off on this and approving the plan ultimately.
And so should any one individual own it?
I mean, Robert, what do you see in your experience? I mean, I don't think that's the right way to think about it. Like, sure, there might be a document owner on the documents, but I don't think that's the right way to think about it, because it really is going to be an organizational wide effort.
Yeah, I think it's very much that. Yes, there might be an owner of the document, but broadly, one single person can't answer a lot of these issues, and you need support from a lot of different divisions, and different people have different views on how it works. So it's really good to get good open workshop discussions on coming up with options, issues, and developing some appropriate strategies for what the wind down plan may look like.
Brilliant. And one that maybe you'll be able to answer, Martin, but with the upcoming changes for the safeguarding regime to align with CAS, are there expected to be changes to wind down plans as well? And I'm assuming that's from a UK perspective.
Yeah, well, I guess the short answer is absolutely, because your safeguarding obligations are such an important part of being a payments business. It's one of your key obligations and your key risks, and it's something that will be particularly important in a wind down context, because as we discussed a few times, the FCA will be very focused on making sure customers get their money back in a timely manner, as quickly as possible, really. So anything that changes the safeguarding regime, and this proposal, it looks like it will change the safeguarding regime in quite fundamental ways, will absolutely have to be accounted for and dealt with in your wind down plan. So yes is the short answer. It's going to have a real significant impact on the way you think about wind down plannings, the way you implement them.
Brilliant. And I'm going to try and make sense of this question. Forgive me if to the person who asked it, if I don't. I'm going to try and go straight with verbatim with what was said. So this is from one person. One thing we did in our wind down plan was trying to understand the ecosystem through PESLA or PESL analysis, which they got from one resource. And our skilled person was a little curious. Is this not a normal thing in the panel's view?
I'm not familiar with the acronym or initialism. This is some sort of management framework. Is it to sort of think about, analyses? If that's what that means, then I think, that helps as a starting point to look, what are the threats? What could go wrong? What are the dependencies? So yes, I think, but let me know if I've not understood the question.
No worries at all. That was our final of our questions to come through. So I'd like to wind up the, pardon the pun, the webinar with a one final piece of advice from you both on how best to approach wind down planning. That would be great. Robert, how about we start with you?
I think it's really about collaborative workshops across the business, getting everyone's views, and it's a theoretical discussion on how things might work. So there is no right answer. There's just lots of good opinions and good challenges to be done. So get everyone together, work through it, and identify fixes where possible. So hopefully it's never needed, but if it is, you've got best chance of getting through it.
Yeah, I definitely agree with that. Yeah, do it. Don't be scared of doing it and talking about it with key stakeholders, and see it as an opportunity to really take a good hard look at the business and dependencies, and use that not just to get your wind down plan right, but also to think about what does this mean for our strategy? Does this inform the way we approach things? And if you get it right and have a good robust wind down plan, that gives you a really great platform to grow from.
Fantastic. That's brilliant, guys. Thanks so much to both of you for a really interesting webinar. And just before I turn back to Jack, I'll say thank you very much to the audience, and particularly for the questions. I'm sure that definitely watch this space, because it seems that there will be changes coming up, whether that's through the PSR and PSD3 in the EU, or with changes to the safeguarding regime in the UK. But thank you everyone for coming along, and I look forward to seeing you at the next webinar. So yeah, Jack, I'll pass back to you now.
Thank you, Jimmy. Thank you, Martin and Robert. And thank you everyone for attending today's webinar. As mentioned at the start of the session, this webinar was recorded and the video will be sent to all attendees in the coming days. Before signing off, I wanted to remind you to stay tuned to Vixio Regulatory Intelligence on LinkedIn for the next Vixio live broadcast, which will take place on Tuesday, July 2nd at 2 p.m. British Standard Time. Using a horizon scanning tool, Jimmy and other Vixio experts investigate the latest regulatory developments and review the biggest changes that have happened in the last month. So be sure to follow Vixio Regulatory Intelligence on LinkedIn to stay up to date. Finally, if you have any questions about anything discussed in today's webinar or would like further information, please email info@vixio.com or visit the website vixio.com. Thank you.
Brilliant. Thanks, guys.
Thank you.